Good evening, option traders. This is Sam, the Trader Geek, with weekly review. Happy Memorial Day, and thank you to anyone who is serving or who has served, um, and those families who suffered the ultimate sacrifice. We can't forget about those who have done so and the families who have paid the price, in addition to those who paid with their lives. Hope you had a nice long weekend, and I had hoped to get this out earlier in the weekend, but as usual, got too much to cover, and here we go. So I'm showing you the SPX daily chart here. You can see after that big up day on the 15th of May, we've just gone sideways with one wide-ranging day on Thursday. A lot of people call it a key reversal candle, could be, but it remains to be proven. Friday, we took back a lot of what we gave up, and even in the NASDAQ, it looks better than this. But you can see here that the week ending Friday the 24th and the week ending Friday the 17th was barely a 1.5 difference. So we basically are pretty unchanged on the week. So if we look up here, we can see implied move for Friday. The upper edge is 53, 30, 53, 54, and then the lower edge of the expected is 52, 55. As you'll see, it's about 50-point range. And last week, we stayed well within the expected move. We're just consolidating sideways for the moment. And I like to leave these prior moves in here, not to clutter things, but so you can see where things are. And now that I've shown them, I'm going to remove last week's expected moves because it's no longer relevant. I just wanted to have them there for perspective. Take a look at what happened Friday, and then we'll take a look at the week and the major markets. As you can see that on Friday, it was a good day, and most of the indices, except for the diamonds or the Dow Jones Industrial Average, closed at 76% of their range or better. NASDAQ was the king of the ralliers, thanks to NVIDIA once again, SPY 0.66. Dow was basically unchanged, and ARK and the small cap growth stocks did fairly well, and they all pretty much rallied from the open, except for the diamonds did not do so. We can see here, if we go down to market breadth, it's really not good. And you can see increasingly red spots here, and even dark red in some of the sectors. And when we go out to the 20 days, we can see a lot of the green turning to red. So we're seeing some deterioration under the surface. The indexes are not telling the story. If we go out to the 50 days, you have about 5 sectors that are starting to appear red, and it just says something about deterioration under the surface, as we'll see more when I show you major markets. Looking at Friday's action, we can see that a good bounce. Miners were up 1.5%. Semiconductors up 1.9%. Once again, thank you, NVIDIA. And solar was up 5%, and crypto stocks up 3%. But a lot of them did kind of, as you can see here, the percent from the open tells you how bad or how they fared after the open. And you can see a lot of these kind of turn red or turn more red after the close. I mean, after the open. And then solar kind of kept most of its gains up 5% on the day. And a lot of that is attributable to First Solar. And I want to bring your attention to something here. This is the National Association of Investment Managers. And you can see the percent invested, and it's been increasing steadily since basically the 24th, after we had that dip in April. and now they're up to 94.5%. And historically, this has been a point where we have seen some pullbacks in the market when they get this far invested. And as you can see over here on 3/27/24, they were 104% invested. And the next week, when we started getting a pullback, that April pullback, immediately came down to 84% invested. How do you get 104% invested? Well, that's what you call leverage. And all the way down to 63%. So we're back about 50% higher in terms of investing by major managers out there. Take a look at some of the statistics we have for the week just ended. And here we go. We have major markets here. And this is from a product called High Growth Stock Investor. Pretty complicated program, but it is a very sophisticated and very tough to master program. But this is a report you can get out of there. And you can see here at major markets, which are kind of telling the story. So this is Friday action in some of these major markets. The dollar declined a little bit, nat gas giving back some, about 5%. And obviously the VIX going down, so that was up 1.6%. But Bitcoin was rallying, was up 3%. If we look at on the week, significantly more red than green in terms of these major markets. The SPY was basically unchanged on the week, as we saw on the first chart. The bonds a little bit unchanged, but worse off on the week were silver giving back 3.6% and gold. So precious metals are giving back 2%. And of course, the Dow was the big laggard among the major indices, down 2.3%. And FANG obviously would help with NVIDIA 1.9. If we look at year to date, we can see that the leader, of course, is Bitcoin, and bringing up the rear, we have ARC Innovation. Hard to believe that's down 15% with a market that's essentially up 11%, but there you go. NASDAQ being 12.7%, and the Q is up 11.8%. VIX obviously is down about 17% on the year, and a lot of the strength and weakness can be tied to the dollar. It's up 5.8%, but yet the market is staying resilient. Bonds are down 7.6% on the year. And so the rest of this kind of gives you stats that you might find helpful, and pause the video to take a look at those. Taking a closer look at the indices themselves, the leader of the pack, obviously the NASDAQ Composite, followed by the NASDAQ 100, and the worst being the Dow Jones, down 2.33%. And what you can see that they're all positive on the month, but last week brought some of these back down for the quarter based on that bad April period. And right now, the NASDAQ and the S&P 500 are up on the quarter, with the rest of the major indices down a bit. Year to date, everything is positive, so that's a good thing. See if I can scroll this properly. Moving on to S&P 500 sectors. Again, looks like the herd is crowding into technology, up 1.59%, and communications was up 0.4%, but energy, real estate, and financials faring the worst on the week. And energy is kind of losing steam, down 2.3% on the month, 0.22% on the quarter, but not as bad as real estate, down 5.5%. And consumer discretionary dragged down by some of the retail names and specifically Tesla. And of late, you'll see Amazon has not really been participating in the rally. It's pulled back quite a bit. Healthcare down 2.24%. So what we're seeing here is basically 3 out of 11 sectors positive. Actually, it's 4 if you count consumer staples out of 11 that are positive on the quarter, with only consumer discretionary and real estate down year to date. So we can see it's a mixed bag here, and we'll have to see if the play for the end of the month and the end of the quarter is going to get all these sectors caught up. Taking a look at some of the industries year to date, and I find my process and understanding what's going on in the markets, if I can get this at the right size, sorry about that, is to study these industries, the sectors, and know where the strength is, because that's where you want to do your shopping, especially if you get pullbacks. And if you don't know where the strength is in terms of sectors and industries, you're not always going to find the big winners. And this is kind of a top-down approach that I take to help find some trades and winners. And if we look at the industries that were top of the list, solar and alternative energy. Solar was up 0.48%, semiconductors with the help of NVIDIA weak, so to speak, 6.08%. But you can see a litany of industries that were down, and cannabis giving back almost 15%. And obviously only 4 sectors, maybe call it 5. Aerospace and defense was up 0.4%, 0.04%. Can't call that one up, more like even. And then going back, because of this week, you can see a lot more quarterly results in terms of industries have turned a little bit red. So year to date, solar and alternative energy are 2 of the worst performers that we have. And obviously semiconductors, aka the NVIDIA show, is up almost 40% on the year. Gaming and esports, 14.67%. Cannabis is still up 16% despite a 27% pullback in May and an 18% year-to-date pullback in the quarter. Couple more here, and then we'll move on. You can see that if you look at the style of investing, anything growth is doing okay, although the large cap growth was the only place to be last week, up 1.5%. Every other style kind of lost money, with small cap value being the worst of the bunch. They're all still positive on the month, but yet only large cap growth is positive on the quarter, and we still have small cap value a loser year to date. And then our favorite Magnificent Seven, obviously NVIDIA, the leader, Microsoft up 2% last week, with Amazon down 2%, Alphabet down 0.5%, and the others just kind of middling. Tesla is down 2.2% on the month. Looked like it started to rally, and it's not finding a good footing. It's the worst of the Magnificent Seven year to date, down 28%. And surprise, surprise, NVIDIA is the year to date leader, with Meta being a distant second in terms of performance. Switching gears a little bit to think about what's coming up this next week. We have tomorrow consumer confidence at 10 a.m. Eastern time. Then Thursday we have the GDP and initial jobless claims. But the real report that we're waiting for is the core PCE for April. So that will be anxiously awaited, along with Chicago PMI. But I think that if this market is going to be slow, and with Memorial Day kind of marking the traditional kickoff to the slow summer months of summer, I think that Tuesday, Wednesday, Thursday might be a little bit slow until we get the PCE report. And what everybody's waiting for is evidence that inflation is easing, so we can get that almighty interest rate cut. Earnings this week. We're winding down the first quarter earnings season. A lot of retail names on Thursday: Kohl's, Foot Locker, Costco, and Dick's Sporting Goods on Wednesday. A lot of familiar names here. None of them really big that are reporting tomorrow, but Costco will be a market mover, so to speak. And for the most part, this ends earning season for this quarter, which has turned in a better result than most anticipated. Finally, if I can get this resized right, I like to look at seasonality. Whether it works or not is irrelevant. Sometimes it does, sometimes it doesn't, but I like to know what to expect. And what you can see here is from the 17th of May on, we do see, or at least for the last few days of the month and the first few days of January, seasonality does seem to kick in and return. So we'll see if this week proves seasonality correct and moves up for this last week of May and then the first part of June next week. Take a look at the expected move. We said it's going to be $50 on the SPX, but I also want to take a look at the VIX. And we'll go here. VIX closed Friday at 12.36 after a low of 11.89. So we got under 12, but couldn't hold under 12. And with the VIX at 12.36, let's call it 12 and a half. $1 out, it's 13 and a half, and that's, let's call it 88 cents for the calls, and then out to 11 and a half in the puts. Let's call that 7 cents. So we have about 12 or 13 times on the calls. And what I want you to also know is the skew, or where the implied volatility in the strikes falls. And I'm not going to explain skew in detail here, but take a look at something that I pay close attention to. So if you wanted to take a shot in the VIX, say a 13-18 call spread, notice that you're buying a 73% volatility call. And then on the 18 side, you're selling a call with 113% volatility. So that's very favorable skew, which means that the out of money calls are pricing in terms of implied volatility higher. And so you're buying cheaper volatility than you're selling. And that's always a good thing when you're doing a call spread. And I watch that on every call spread I do, or every put spread that I do, to make sure that the skew is in my favor. It doesn't always happen that way, but it really does give your trade a little bit of a tailwind. But a spread like that is more of a lottery ticket, in my opinion. But I do think, based on all the indications and the key reversal, if it was indeed a key reversal, at a minimum, we should see some consolidation and pullback over the next few weeks or so. Even if it doesn't mean that we're ready to go down. With all of that background, hopefully you find that part helpful. Let's take a look at the trades that we have working for us. And you can see this list is, make this a little bigger, down to about 10 names. And I like that, given the market conditions. We closed a whole bunch last Friday and Thursday. So we'll start at the top. We have the Chewy bull puts. We're up 60% on those. Expire on June 21st. Still going in our favor. DBX, Dropbox. So far, not going the way I had hoped. We're down about 44%. But we're about at $1.39 away from the stop. And you'll notice that Box, which is in a similar line of business as Dropbox, will report this week. So if they do well, so will this. But for 40% option, I'm not going to worry about it too much. But if you are, you'll want to watch out for Box's earnings or take this off if you're concerned about the effect on Dropbox's earnings. I think these are two companies that are in similar businesses, but I view Dropbox as superior in terms of their technology to Box, but that's a personal opinion. Microsoft, again, looking for some increased volatility so we can roll this out and continue to make money on this. We're up 96%. Maybe this week we get above 13 or 14 volatility and roll this out and collect some premium. Meanwhile, we're up nicely on this. Novartis up 29% on this. We're still waiting to take our first profit. Came within 50 cents on Friday. PSTG was looking like close to being a stop out, and we're still alive on this one. We're up 27%. Our next target is $7. I'm going to try shrinking this down once. Sorry for all the scrolling. Starbucks needs to regain its footing. We're down 12.85% on this. We already took one profit target, and the next one being the SPY calls. Those are the ones that we rolled from the original strangle that we put on. Actually, it was a straddle that we put on. The put side didn't really get a whole lot of juice on Thursday in that key reversal. Still alive. June 14th expiration for both of these. And so I'm going to be looking for opportunities to start closing these out because decay will start setting in when you're within about 3 weeks of expiration. And we are now within that 3-week window to expiration. Target, the put, Target had its third up day since the earnings decline. So we're up 40% on that. That's kind of nice. And TLT, still kind of going sideways, not really doing a whole lot. We have about 25 days on this. Again, this one going to be looking to see if we need to either roll it out or close it out and be happy with the profits that we took. We opened one new trade on Friday. Thought that USO or the oil ETF was oversold, and so selling or buying a call spread, 75-80 call spread in July, seemed to make some sense given the relative inexpensiveness of the options. And we'll see if USO can't muster a decent bounce to give us some profits in this particular commodity. Well, that's all I had for you tonight. I appreciate you watching. And if you have any questions at Trader Geek on Twitter or in the forum, hit me up. Have a great night, and we'll talk to you again soon. Bye-bye.